is approval of the subdivision participation form authorizing you to sign enough, or do we need separate action to have you represent us on behalf of the county in this issue?
No, I think I can represent you from here on out. I just need to know that you approve this particular Sandoz settlement.
Okay.
I would make that motion.
Support it.
Motion from Helmers, support from DeBoer for approval of the subdivision participation form relative to the Sandoz settlement. Any further discussion? Hearing none, those in favor of approval signify with aye. Aye. Those opposed, same sign. We can proceed with that one, and we'll look to future discussions on utilization.
Thank you very much.
Thank you. Have a good day.
You too.
All right, how far did Dave get?
He's in the auditor's office.
Imagine.
Did you see the text from Bill? Go to 10,000, we'd save $7,392 a year.
What is that?
What?
What is that for?
By going to a $10,000 deductible. I don't know how it got.
So we just finished up showing how we reconcile the government-wide to the fund statements, Exhibit C to Exhibit A. So then we go into the funds, and how did these major funds change during as well as the non-major? So the non-major ones we can see when we look at Schedule 2 later on. So again, how did it change during the year? The third to the bottom line is really how it changed. And again, you can look at the management discussion analysis, pages 12 and 13, to kind of give you an idea, how did the revenues change, how did the expenditures change, what percentages did the fund balances change. So utilize pages 12 and 13 to kind of give you a summary of these individual funds. So general basic dropped by $304,000 from 3.6 million to basically 3.3 million. Our general, including supplemental, all the different general. Rural services went up by 63,000 from 623 to 686. Secondary roads increased by 37,000 from 5.7 to just over 5.8. The amended ethanol TIF areas P&I, which is basically paying off your Series 2019 GO bonds, which you did pay off during the year. That's the reason for the large decrease in there, dropped by 278,000 from the 302 to the 24,000 left. And then you have the CFE TIF P&I, which is paying off your 2007 Series general obligation bonds, and that actually increased by 1,197, so it went from a slight deficit balance to 1,034 balance in the fund balance in that. Non-major revenues went up by 311,000 from 6,000 to 318. So overall, it was a drop of 170,000 between all of them, primarily due to the general, but also due to paying off those bonds early would be a large reasoning for that as well. So then, of course, we have to have the reconciliation of how we go from the changes in the individual funds, which we just looked at Exhibit E, to how did the government activities, the county as a whole, change, which is your Exhibit B that we looked at. And again, we start with what's that change on the governmental side, and then we go through all the different steps to reconcile to how we came up with the change in the county as a whole. Since the timing of different things, long-term items are recognized on the government-wide for a county as a whole, while they're not recognized. We're looking at a short-term basis, and those sort of capital assets, long-term debt, are not included on the fund statements. Then on page 30, it just lists your employee group health fund, and you have basically 1,139,000 almost reserved for that, restricted for employee health purposes. On page 31, we show how did that fund balance during the year. We list the revenue expenses. So the net income as a whole went down just under 28,000, which is a 2.4% decrease. So you started with 1,166,000 and you ended up with 1,139,000, just under. And then, of course, on page 32, we just show you how did the cash change in that health fund. It's a requirement. So if you'd like to just see how cash changed, that just gives you an example of a walkthrough basis of how that happened in that employee fund. Then page 33 and 34, we basically get into your custodial funds, basically the different offices, the different entities that you collect taxes on, your emergency management, your assessors, E911. That's basically, so this is the summary of all those custodial funds. So basically this is a summary of when we look at the detail of Schedule 3, while Schedule 4 is the changes in the custodial funds, what was collected, what was paid out during the fiscal year. And again, this is a summary of Schedule 4 that we can see the detail on. Then we get into the notes to the financial statements. Basically, I'm just going to kind of point out the highlights on the notes. So we basically, in note 1, list your significant accounting policies. We list in A, the reporting entity. We talk about that you have blended component units, which is your drainage districts. We talk about the public safety and the relationship you have with that, transactions that go in back and forth with that. We talk about where you're part of jointly governed organizations and what entities are you guys board members of or related to, and the transactions you had with those entities, as well as the joint venture that you have with the different cities in the county for the Osceola County Economic Development Commission, and again, the transactions that went back and forth with the Development Commission this last year. Then 37, again, kind of like we talked about when we were talking about the MD&A, we explained the government-wide financials, that exhibits A and B. Then we talk about the different fund financial statements, which are after that. We go on to talk about the measurement focus and accounting, and basically how do we determine when things are recognized in the financial statements. Page 39, we get into the different components of the statement of net position, the change in the statement of fund balances. We list basically what the major categories are. So if you're wondering, if you're looking at that statement of net position and wondering what's in a particular asset or liability, you can go to here and it kind of explain to you what's the county's policy on it, what's included in that categorization. So we go all the way to page 44 on that. I did want to point out on 41, in the middle of 41, this last year we implemented the SBITA, the subscription IT. We talked quite a bit of length about that, and also we implemented when leases go into effect, and those are talked about on page 42. This is the first year where you are basically leasing something over a period of more than a year. So basically, you and the public safety are each leasing half of a RICO copier, and since it was over $5,000 and the agreement extends over a year, that becomes a lease, right to use lease asset that we disclose, and then we report liabilities for that as well. So I just wanted to point out that that is a new, while you have the policy in place, this is the first year you've had a transaction which actually met those parameters to disclose it. So I just wanted to point that out for you. So then on bottom page 44, we just talk about the budgetary and state that the county did not exceed its budget for any function or for any departmental appropriation. We go on to talk about on top of page 45, the same with the commission. They did not exceed their total budget because they just go by the total. We list the different investments that by statute and your county's investment policy, which you can invest in. The county is invested in basically money markets, CDs, and then you also have put money into iPay. The amount of money that's in iPay is $2,221,409. And so we just kind of explain that to the user. Note 3, basically here, we're just going on to explain the due to and due from different funds. So you have interfund receivables and payables. Some of it's due to the timing of transactions between funds. Some of it's due to basically interfund loans for TIF purposes. So we go on to explain each of the interfund liabilities at the end of June 30 and the reasoning for each of them, so you can explain why do we have this interfund loan receivable payable. So interfund transfers, we go on to list the different interfund transfers on a modified accrual basis, and we go on to explain what is the reasoning for each of those transfers, so you can understand why did we transfer money from one fund to the other fund. Capital assets, here we go on to list all the different capital assets, what transactions incurred during the year, both what was new additions, what were some things that were like what was destroyed by the fire was removed, stuff of that nature, what was traded off, sold. And this is where, if you were to look in that, the right to use leased equipment is included as a capital asset. That's $7,240, and then basically we're amortizing it over the life of the lease, and you get a right to use leased equipment accumulated amortization that will go over the multi-year period. And then we do the same for the Public Safety Commission, and as well it has that new right to use lease and that amortization as well. So the land lease is receivable. Again, this is something we've implemented. So anytime a lease that you basically are leasing farmland, for the most part, to someone over a multi-year period, we also have to basically bring it down to its present value, and then we basically, as the lease goes on, we recognize part of it as just a payment on a receivable, and part of it as considered the interest component of it. And so we explain each of those different leases that you have, and then we talk about what's the expected payments you are to receive on each of those leases. We first do it by the general fund, and then we list the land that's being leased through the secondary roads fund as well, as a separate component. Due to other governments just explains the reasons what each of the funds are owing another government, what's the purpose of those. Long-term liabilities, again, we go on to list each of the long-term liabilities as it shows up in your government-wide financial statements. We list what the beginning of the year was, what new additions there were, any decreases, and what's the ending fund balance, as well as what is expected to have been paid in 24-25. We do show that the 2019 series bonds were paid off, and we do list the lease agreement as a long-term liability that we discussed previously. So basically, after that, we basically list the selected debt, basically the bonds, the drainage, the IT, the lease, and explain those. We disclose the terms based on how much are you expected to pay each year in principal and interest and in total. And then we basically do the same, as I said, for the drainage. We list that IT liability, and you're in your final year. Just finished your final year for the IT subscription. Again, is software that you have a multi-year agreement on. You just finished last year with Solutions, so you probably entered into a multi-year agreement. No, you did not.
They did not offer that anymore.
Okay, so we may not have that submitted anymore then next year, since it's only multi-year, so they're not doing that anymore. Okay. Then 9 is basically your pension plan. This basically explains that the county's part of IPERS. So we are required to disclose how does IPERS work. It lists basically how IPERS works, where you can get the information, how the values were arrived at, what actuarial assumptions were used, what interest rates were used. Explains the county's percentage of what the liability is and future inflows, deferred flows, what the pension was because of it. So basically they just determine what percentage is your payroll of the Iowa as a whole, and then they say, okay, this is our numbers, whatever percentage that is, you have to recognize that percentage of deferred assets, deferred liabilities, long-term OPEB, pension payable, and then pension expense. And then we basically do the same thing for your OPEB, which is your group health plan, and you do have an actuarial report on that. So we basically summarize that actuarial report and put it into terms of that. Page 57, we get into risk management. We talk about that you're a member of ICAP, the Iowa Communities Assurance Pool. It goes on to list ICAP and explains the different coverages ICAP offers and talks about that you haven't exceeded the part of the pool, any claims in the last 3 years. And the pool's never been exceeded. So it talks really about ICAP and your relation to that. The employee health insurance plan basically explains your exhibits G, H, and I. So G, H, and I, this is a summary of your health plan that you have. The developmental agreements list your different TIF development agreements that you had during the fiscal year. It basically goes on to explain for each TIF agreement, development agreement, it's an explanation of it. It lists what was the fiscal year 23-24 rebate, how much has been rebated to date, and how much is still possibly could be rebated in the future under the terms of the development agreement. And that goes all the way to page 60, because we listed for like DAC and KJSJ, Lane Strat, Loneman, and then the CFE. Tax abatements just talks about money that's been abated due to different development agreements. And then tax abatements with other entities within the county, which there is none. Intergovernmental agreement, this just goes on to explain that you're part of the Northwest Iowa Solid Waste Agency and kind of lists the numbers as of June 30, 24 that the waste agency reported and how you are in relation to them, and that you guaranteed a $306,000 assurance guarantee for that past fiscal year for that. Deficit fund balances, we go on to list that there's 3 funds when we look at schedules 1 and 2 that have deficit balances. They're all they're TIF ones, the amended ethanol TIF, the Cenex Co-op TIF, as well as the CFE TIF area. Reasoning for the deficit is because you haven't collected the TIF revenues to pay off the debt that's already been incurred. So by nature, they're going to have a deficit position. And you will pay those off as you collect this, the TIF debt. But however, it's a deficit position, so we're required to disclose that. But nothing I would be concerned of based on that is normal based on the type of debt you've incurred in those TIF areas. So commitments just listed the different commitments that were outstanding as of June 30, 24. Estimates talks about estimates are a huge part of financial statements, and estimates can change in the short term, so do take that in consideration. There are a lot of estimates going in this, as well as events that happen, major events that happen in 24 and 25 to date. Any questions on the financials and the notes, first of all? So that's basically where we give an opinion in that first part that says we're fairly presented. We're talking about the exhibits and these footnotes. So then we go into the next section, the RSI. We do limited procedures on this. We're not actually rendering opinion. We're doing more comparison and saying it looks reasonable in relation to the financials, but we're not actually issuing an opinion on it. So first of all, we list the budgeting for the county as a whole for all your government funds. We list all funds, then we remove in the second column the drainage funds from that to come up with what the net county budgeted funds were. We list the original and the final budget, and then what's most important, that final column on the far right, we list how did you actual come in compared to that final budget. So your receipts came in $605,000 higher than what you budgeted. Your disbursements came in just under $3,972,000 below what you budgeted. So overall, you came out better, $3.5 million, $3,577,000 better than what you had budgeted for. So then we go on to list, because like I said before, we love reconciliations. We reconcile how do we go from your budget on the cash basis, because this is a cash basis, to the modified accrual basis financials, which is your Exhibit E, and we list the adjustments we make there in a more summarized fashion. And then we have the public safety's budget as well. And so we list there again what their budget was. They did not do any budget amendments, so the original adopted budget is their final budget as well. And then how did they come out? They came in $18,342 better than what they budgeted for receipts. Disbursements came in $112,500 below what so they came in $130,000 higher than what they budgeted for. And then we, of course, have to do the reconciliation for this budget compared to Schedule 7 for Public Safety Commission as well. On page 70, it just explains for a reader how you go about deciding on your budget, how the budget works, and that you amended your budget 2 times. Then on pages 71 and 72, we just go on and talk about IPERS and list the proportionate share of IPERS that the county and the Public Safety Commission had of the share of IPERS, what your payroll was, and basically gives you a 10-year comparison for the last 10 years as your shares of IPERS. And then we go on page 73 and 74 to explain how much the county's contributed for the last 10 years, as well as the Public Safety Commission to IPERS, what the county's covered payroll was for IPERS, and what percentage that amounts to as a whole. And then on page 76, it just lists the actuarial methods that IPERS uses when they determine, when they're doing their report that these numbers are based on. And then we basically do the same kind of thing for the OPEB liability. We list the OPEB liability, give you some different ratios for that, and list how that has changed for the last 7 years for the county and for the Public Safety Commission. And again, would reconcile to that footnote that we discussed earlier on OPEB, and then the OPEB assumptions that the actuarial used when he determined the report. So that's the RSI where we give limited assurance on. Then we get into our supplementary information, which we again do state an opinion that these are fairly presented, and you can rely on these. So in Schedule 1, we basically list the different non-major special revenue funds on a modified accrual basis. So it's all the remaining ones that weren't identified as being major for special revenue funds. And you can see these are listed here. And then that total column is what then gets reported on Exhibit C for the far right. So again, what's most important is the fund balance. That's second to the bottom line, so you can kind of see in each of the different funds what makes up those balances. Excuse me, you can see that those deficits are in those TIF funds, as we discussed, but explain the reasoning for that. And then how did they change during the year? Those fund balances, you can see that on pages 83 and 84 on the modified accrual. So we can list the different revenues, expenditures, and how each of the different funds changed. You can kind of go along there. You can see the larger ones. You have the emergency medical services, which was the first real year of that. So you may have an interest, there was some accruals work from the year before. This is the first year it was fully in place. So you can kind of see the revenue and expenses and how that went up by $81,000, which is basically the interfund transfer that you decided to do, and which is explained in the notes. Then it talks about, like, the opioid fund went up $37,000, lists the different TIF funds there. Drainage went up $106,000 based on transactions with stamped, how you did your stamped drainage warrants, and then as well as so that's how we come up with the $311,000 change, which again, all these are summarized on your Exhibit E that we noted earlier. Then we list the different custodial funds. So you can see along the top, it lists each of the different funds that you're acting in a custodial nature for, and again lists what assets, liabilities, deferred inflows, and what the net position is that you're holding for those different county offices and entities. And so then which is again summarized in your Exhibit J. Then we On 787 and 88, we go on to talk about the changes in the custodial funds, what was collected during the year, what was paid out for each of the different custodial funds. So you can kind of see how much money is flowing through each different custodial fund. And again, this summary is put on Exhibit K. So this is meant to give you a detail of that Exhibit K. Then we get on page 89, the modified accrual basis for the Public Safety Commission. So basically, what's important again is the fund balance. So you have 21,183 is in prepaid expenditures, while the unassigned balance in the public safety on June 30 was 1,290,000 for a total fund balance of 1,312,000. Then on page 90, we basically reconcile Schedule 5 to the full accrual on Exhibit A. Again, walks you right through what adjustments were made to reconcile Schedule 5 to Exhibit A. And then we use the same thing for that change. So how did the change in public safety go during the year? So it basically increased by 29,563, which is an increase of 2.3%. So it went from 1,282,000 to $1,312,000 there. And again, Schedules 5 and 7 in your MD&A earlier, you could go back and kind of see what's the main reasoning for those changes, as well as giving you the reconciliation from Schedule 7 to Exhibit B. Again, walks you through each of the different adjustments we do. And then, which is a kind of a nice little handy chart on page 93 and 94. So for all governmental funds, and then for the Public Safety Commission, it gives you a 10-year comparison by revenue classification and by expenditure function of what the totals were for each of the last 10 years. So you can kind of just get a, back to 2015, how much has our revenues changed? How much has our expenditures changed? And you can kind of see, between the years, how that has evolved over the years. So then we get into our report on internals and controls and compliance. So basically, on this report, we're stating that the purpose of this report is just to talk about our testing that we did on internal controls and compliance. We did not do an audit of your internal controls and compliance. However, when in performing our audits, we just note some things that we feel could increase maybe the chance of eliminating maybe an error or some sort of fraud or anything. So we list material weaknesses as well as significant deficiencies. And then if we came across any compliance issue, because we do a lot of testing of code, but again, we don't do it on all aspects. But the parts we did, if we do notice anything, we do state it here as well. But none of it was material. So I do want to disclose that the non-compliances are considered immaterial. So it's not significant in the point that, whoa, this is changing everything. This is an alarming concept of the compliance issue. Segregation of duties, so we just talk about incompatible duties, and every small government honestly has this segregation of duties comment. We just ask that you kind of look department to department, try to use the staff within the department or use other offices to try to eliminate one person from doing from the beginning to the end of a process. Information systems, we're just talking about different IT type of passwords and logging off sort of compliance type, controls that maybe help to prevent anybody from, nowadays hacking is a huge problem. Scamming, that's a whole nother thing, which kind of goes along that as well. So it's important to recognize that. Job rotations, again, talking, some offices do, some offices don't. Make sure your people in financial positions should be rotating their jobs, so that way one person needs to be taking a break, and so it's getting rotated. Ambulance records, we're just talking about there, just reconciling to the state's offset program and reconciling the QuickBooks more to the treasurer's ledgers, write-offs, basically reconciling the QuickBooks to the financials and the ending receivables. Financial reporting, we just talked here that we didn't do material adjustments to adjust from your cash basis records to the modified and full accrual. So we have to note that we did do material adjustments that was approved by the auditor's office to get from the cash to the full and modified accrual basis. Management procedures here, because some of these findings have been in there for a few years, we do have to note that that is an issue, that becomes an issue if it hasn't been corrected for several years. Payroll, we just kind of like to see all timesheets being signed off by the supervisor, some reporting issues in the newspaper, some problems with filing of payroll tax forms, and needing to do some amended, as well as some clarity maybe on some payroll issues for part-time employees would be helpful as well in the payroll side. Capital asset records, here we're just talking about developing systems so that way when an asset is bought, it goes on to the detailed capital asset records. When it's traded in or disposed of, it's removed. And again, that's coordinating with the different offices. The offices got to coordinate with the auditor's office who keeps that summary, and coordinate with them so that it's all inclusive in one spot. Accounting procedures manuals, not all offices have procedures manuals. So again, we're just looking at on an individual by individual office to make sure they have procedures. And then collection procedures such as for mainly the ambulance, the jail stays, and just procedures on when they should write off that debt. So those are all just suggestions on internal controls. Then we get into that compliance. Like I said, nothing significant, but the budget was followed. There was no problems with the budget. We did notice some, like, mainly credit cards for like meals and stuff where there's only credit card slips, there's no detailed support. So we'd like to see that there is detailed support, because we don't know if you're then feeding yourself and your spouse or something, you know, that's just something we just like to see. Easy to say, hard to do. I have issues with my staff getting me the breakdown on some of those credit cards, so I get that. Make sure that invoices are marked for payment, all of that stuff. Travel expenses, we didn't identify any travel problems, but again, if it's missing in a receipt of a credit card, it's possible it could occur. Business transactions, all business transactions, you were in compliance with the code, either through bidding or through the procedures you did, you were in compliance with the code. Restricted donor activity, we didn't notice any problems with Chapter 68B. Your bond coverage was in accordance. Your board minutes, we didn't notice anything that didn't comply with the code. Deposits and investments. So the local government opioid abatement fund is supposed to be collecting its own interest. And we did note that last year, so I worked with Becky, and she talked with Solutions, and she actually attempted to implement it in 24, and she showed me how she did it. However, they didn't basically code Solutions quite right, so she had it going to the opioid fund, but when it ultimately got posted, it posted it still to the general fund. So the money for this last year. So I have visited with Becky. She's assured me she's worked with Solutions. They have it corrected, and now that will be taken care of. So, and we do recommend that go back to the beginning and allocate any interest over to the opioid fund. Followed the code, your annual urban report, and you did with the code. The TIF, we just worked with Chantry on getting some TIF, making sure all the TIF worked out, which is extremely confusing, to give credit to Chantry on that, but she does a good job of that, but we did help her with that, and so we're just noting that. Financial condition, we've already talked about, that's just those TIF funds. And then a deficit cash balance, we did note in that debt service CFE P&I from August 8 to October 10, you did have a deficit balance. Reasoning were the bond fees came in a little higher than expected, so it had a very minuscule deficit balance. Of course, it's been taken care of, but again, we just have to recommend that it never goes to deficit. Should have done just a short-term loan to make it from the deficit, but again, minimal. Questions is 12. A few minutes after for the lawyer. So.
Okay, so the credit card receipts, that's been a thorn for a long time. How, and the credit card automatically comes out. So I could refuse to pay it without
But it's gonna come,
is gonna come out of the account. So how do we handle that going forward?
So realistically, you're gonna have to rely on each individual office. Each supervisor needs to basically, if you have a department head meeting sometime, basically you gotta stress to them and say, hey, the auditor keeps naming us on this. You guys need to make sure you drill into your employees that we expect to see a invoice to back it, to the point of, okay, we're not gonna reimburse you for it. But again, it comes out automatically, so.
And then we got gas the other day when we were using the county credit card, and of course, there's no paper in the thing. So Chrissy took a picture of it and we'll print it out and attach it to that. Is that,
That's,
it's okay?
yes,
I mean,
that's okay.
we can't help that we
Yes.
can't get a receipt, but
Right,
that would
right.
be.
But that would suffice,
Okay.
yes, yeah.
Okay.
Yeah,
You know something, I had that happen, and I went and got a receipt. This is by you having to come in and get the receipt, I got free slushy.
Oh, well, this was in place that there wasn't a store. It was one of a co-ops.
I couldn't believe that just by walking
Yeah.
inside the.
It's pretty nice. Okay.
but yes, that would be good, so. Yeah. The only other thing, I guess, on the credit card to answer that would be to say, okay, if you're not gonna be turning in your receipts, you're gonna lose your right to have
the credit
access to the county credit card. I think that's probably the ultimate, what would have to happen to truly.
In a situation like that, a gas pump receipt didn't print, writing it on the claim form isn't
Yeah.
sufficient, or?
We would be fine with that, because it's, as long as it's not 90%.
Yeah,
You know what I
every time
mean?
you do
So,
it,
but yes,
yeah.
but okay, we understand that can happen. Absolutely.
I didn't think of taking a picture of it. Makes
Yeah, that's
sense,
what
too.
Chrissy did that when we were.
You wanna ask about the bills? Like, should we do Bosma Water separate when we pay bills?
As long as you're abstaining from them, what you've been doing, we're fine with.
Okay.
We don't see that as an issue.
My understanding was with the vendor approval, without my participating in discussion or vote, is that sufficient to then approve claims without going through the separate approval process?
So will you go over the 6,000?
Probably not.
So as long as you're not
We
gonna
did
go,
do some work for the building, but that was through the contractor that was hired.
oh, okay, so again, you're not billing the county for that. Right, so as long as you're not gonna go over the 6,000, I think the vendor thing is just fine.
We'll just keep doing what we're doing. What's the vendor thing accomplish then? If the 6,000 still stands?
Well, as long as you abstain, I guess, after that, we're fine with that. I'm kind of being wishy-washy here, and I get that. So the vendor listing, and you're the only one in the county who provides the water service, aren't you?
I think out-of-county services would be available.
Right, but you're the only one in the, I would, so, as long as you put it on the vendor listing, it's approved, and it's your normal sort of thing. So let's say you would have done something special that caused it to go over the 6,000 because of something larger, that would be the time maybe we still wanna have it formally approved or something, to clarify that. Your normal transactions, I'm not worried about. It's just like something, if you did something for the building project and it goes over 6, then the vendor listing, I don't think would suffice. Let me clarify that then. Does that make
Did we
sense?
not at that time? Huh.
We are in schedule to update our handbook. Jack just told me, so I guess we'll talk to you. There's certain things that we need to change in the hand.
Yeah, it's just kind of to clarify if a person, which, you basically have a couple people, it was basically the ambulance and Dan, that basically, they're working in multiple departments. So then it kind of, there was some unclear based on the way that it was worded as to which what are their benefits, what do they get for vacation, sick, because they're in multiple departments. So we just want to make sure that's clear.
Well,
You know, and again, because we just want to make sure that it's, how it's written, that your office can say, this is what's intended, this is how we're implementing it based on, it's written clear enough that we're not going, well, I don't understand.
yeah, we need to really clarify that more.
Right, because I think your office kind of struggled with that
Yes,
wording.
very much so.
So that's what I feel, it needs to be clarified, so this isn't happening for your office.
Okay, okay.
If you need us to, like, the line just recently did ours, and then they just sent us their part of that, and just said, here, look at this. This is our interpretation, do you have any issues with it?
Okay.
Yep.
Yeah, Jack just informed me that that's a goal, so we'll see what happens.
Perfect. Well, thank you for your time, it's always a pleasure. As always, you can certainly contact me at my office if you have any questions that you don't want to discuss here, or get a hold of Rochelle, and she knows where to find me. So, thank you for your time today, appreciate it.
Thank you.
Dave.
Thanks, Dave.
Anything further, gentlemen? Madam Auditor.
So our premiums are due for our liability insurance the 15th of July. So what are we gonna leave it as is a deductible, or are we changing the deductible, or what are we doing? Or we have to,
There's quite a difference in
don't really have to.
I'm in favor of leaving it the way it is. I don't think the savings with the higher deductibles are enough to make it worthwhile.
7,300 if you go to 10,000.
Like 10,000.
Yeah.
If we just had an air conditioner claim, that would cover 4,300 again.
Go 73.92.
Didn't they say something at the fairgrounds that?
Yeah, I don't know how much damage was there, but
Right, but if you're paying 10,000 for deductible versus 1,000, that ate up the 9,000 or the 7,500 savings.
Yeah.
Depends how many credits we're gonna have in a year.
unfortunately no one knows that answer.
Don't you have a little crystal ball?
I do not. I wish I did, but I do not.
But that claim is coming up soon. Is there action you want to take based on that having been on the agenda?
Would that keep the departments from turning in the smaller claims?
To be honest with you, I wasn't even going to turn it in until I talked to Bill. He said we might as well, because I didn't want the little piddly stuff. I didn't want it increasing our premiums, but I don't know. It was only $1,000, so I did, or he said we should, so I did. But I had thoughts of not. But I don't know, whatever the board decides.
So I know myself with, if I have a claim at home, if it's just a little bit over my deductible, I won't turn it in. The only good part is that they've never canceled anybody. That's the only good part. Because I know when I went to adjusting school, they told me the first claim, yeah, don't worry about it. Second claim, start thinking about it, because the third claim's going to get bigger. And they told us basically think about canceling after 2.
Let's make a motion.
facilities or economic development, future agenda items?
They're doing the floors on July 25th and 26th, so the courthouse will be unavailable that weekend for anybody, but shouldn't be a problem.
Is there a motion to adjourn?
Motion.
Motion by DeBoer, support from Loring for adjournment. All those in favor signify with aye.
Aye.
All those opposed.